Hello and welcome to another Simple Trading Ideas trading tutorial. In this Simple Trading Ideas trading tutorial, we're going to cover the basics of using indicators to make trading decisions. And this is simply part one in a multi-part series. So, in order for us to take a look at some indicators and see how they can be used to make trading decisions, we'll need to go to a chart. And here we are in a chart of the QQQ ETF. And the nice thing about using charts and technical analysis in general is that the general principles are applicable to a wide variety of financial instruments. If you happen to be a person who enjoys trading futures, that's fine. Forex currency pairs such as the euro US dollar, pound dollar, etc., then that's fine. Stocks, stock indices, however you like to trade, whichever instrument is best for you, or combinations of the instruments. Again, the underlying principles of seeking price patterns and looking for trends and entry and exit points are applicable to any chartable financial instrument. Okay, so here we are looking at a simple bar chart of the QQQ, and what we're going to do is we're going to place an indicator on this bar chart. And of course, the most widely used indicator, and one of the simplest ones to understand, is the simple moving average. So let's put that on our chart. Alright, so the blue line that you see running through the prices here is a simple moving average. It's a simple 10-period moving average. If you want to see a little bit more about what the moving average is comprised of, we'll take a look at our data window now. And as we're looking at our data window, I'm going to grab some more recent prices. As you can see here, this ends in 2011 on the first day. Right here. So we're going to move on to more recent prices and take a look at the moving average as well. Okay, here we are looking at some more recent prices, and in our data window we can see our moving average changing as the price changes here. It's dropping. You can see it's starting at 65 going down here, and in this particular case we're looking at a 10-period moving average. And the 10-period moving average in this particular case is a 10-day moving average as we're looking at a daily chart. Okay, and that's simply the average of the closing prices of the last 10 periods, or 10 days in this case. Okay, so all the last 10 are added up, divided by 10, and we get our moving average. For instance, if the last 10 days all had a close of 60, which of course would be unlikely, but we're simplifying things, then the average itself would be, moving average itself on at the end of that period would be 60. Okay, so you can see here open, high, low, close. The standard way of using the moving average, or calculating the moving average, would be using the close. Okay, you can calculate moving averages of the open, the high, the low, the close, any combination of all these. You can add them all together and call it the average, moving average of the midpoint between the high and low, etc. Most common data used is the closing price itself. So now let's get into how we would use this moving average indicator as a tool to make trading decisions. I'll close the data window here. Okay, we'll continue. And we're going to, let's just scroll back in price. And this is where we were earlier. Okay, let's take a look here. All right, as you can see, the prices fluctuate and the moving average moves, and essentially the moving average smooths out the many gyrations that the closing prices are going through here. So this is smoothing it out. And typically, a moving average is used as a trend indicator. So we're looking for a trend, and here, for instance, might be looking to buy when the close is above the moving average. And again, you want to have specific things whenever you're looking at ways to trade. You want very specific things in order to eliminate subjectivity. So in this case, we would look at this and say, if the close of the day is above the moving average, we're taking that as a bullish sign. Okay, and that's the classic interpretation of the moving averages. If the closes above it, then the trend could be said to be moving up. But here, there is no clear. It's just on the end of the downtrend. So, okay. So we go back down, we close below, we close back up. And in this case, you can see this is a clearly defined uptrend, so things are moving along. Okay. So let's take a look here. Now, all trends won't really be this clean, as you'll soon see. Okay. So let's establish a set of rules for trading the moving average. These are the standards. Let's say that if the closing price, which is the right tick we see here, is above the moving average, that we buy. And when we buy, that's also known as going long. And let's say that if the close closes below the moving average, that we sell, or we sell short in anticipation of the market continuing downward. Okay, so let's say we're in this particular trend long, just for the sake of simplicity here. And as we move along here, we can see that that trend's holding quite nicely. Again, they won't all really be this pretty. In this case, the saying, the trend is your friend, is really true. Okay, so here we get our first close below the moving average. Okay, so in this case, you would be, according to our rules, right here, we would be selling short. Okay, but let's make that a little bit more specific. Okay, let's say that on any occasion we have a close, okay, here that's below the moving average, and let's say what we're going to do is we're going to sell at the open of the very next bar. And a bar can be a day, a week, a month, a minute. In this case, it happens to be a day. Okay, and as we spoke of before, technical analysis can be used across many different financial instruments. It can also be used across many different time frames as well. Just to clarify that for you. So, okay, so in this case, here we would get an entry trigger. Here at that particular open, we would actually be selling. Now, we're not looking at any other rules. We're ignoring the obvious uptrend here, and we're just strictly following the rules as outlined in the typical interpretation of the moving average. Okay, so we'd be short there. We would still be short. At the end of this period, we would exit our short, since the close is above the moving average. And over here, at this particular point, right here, we would buy or go long that open right there. Okay, so we would be long. We'd still be long. We'd be in this particular trade, which is fine for the time being. Okay, so here is when we would exit our long from right here. Okay, right at this point. And here is when we would actually sell short because we're beneath the moving average, right? So, okay, so we're beneath the moving average, and we would officially be short. Okay, so we go short, we sell short when we anticipate downward market movement. Okay, now here's something interesting. We're still below, up here, out of that short, and then close above the moving average. We're buying here at the open, so we are officially long at this point. Okay, and when we say we're long, this means we're bullish. Okay, and we go back down here. Okay, now something you may have noticed is we've been in and out of a number of trades. Okay, and this is based upon the current market action in relation to the particular moving average. This is a 10-period moving average, and you can have a moving average anywhere all the way up to, you know, if you want a 100 period, a 200 period. The 200-day moving average is quite commonly used as a trend indicator in the stock market. So you have a wide variety here. So this isn't an etched in stone absolute, you must use a 10-period moving average. This is an example solely for the purposes of illustration. Okay, so here we go. All right, so we're back here. As you can see, we're no longer in our buy or long position. We've closed below the moving average, and we are selling at the open of the very next bar as we go down. Okay. Okay, so what happens here is the close above, so we're out of the short. Here we actually buy the open, and we are then officially long. And then, as you can see, it's closed below the moving average. We're officially short. We'd sell here, okay, which doesn't move very far, does it? And the market moves up here, up against us, and we stop right here. And as you can see, if we sell here and we go up here, then we would be, and we close it out, then we would be selling short here at a loss. Okay, so we would buy the open here, go to the next phase. Okay, and now you can see this wasn't the best possible trade we could have made. Now, what you'll find with indicators of all types is, yes, there are, if you're using a standard interpretation such as we're using, this signal was one that was not the best, right? And that does happen. That's why the use of indicators, the use of charts in technical analysis requires experimentation. So it takes time in order for you to learn what works, what doesn't work, what types of patterns are those which are likely to repeat themselves and produce profits in the future. Okay? Because the real important thing is the data that we haven't seen yet, the future data, and how the particular indicator that we're using will react to that future data, and how in sync it will be, and how in sync our interpretation of the indicator and what it means will be. Okay. Now what we're going to do is we're going to conclude this first section using indicators to make trading decisions, and we're going to come back, and when we do come back, we're going to look at using an indicator to create a simple trading system. Thank you for taking the time to join us for another Simple Trading Ideas trading tutorial. Please feel free to come to our website at www.simpletradingideas.com for more great trading information. Thank you and have a phenomenal day.